Right now, an astonishing $5 trillion is pouring into artificial intelligence, driving the U.S. stock market to absolute record highs. Wall Street is currently financing a massive physical build-out across the country, treating code as a secondary concern to hardware and real estate. This starts at the microscopic level. Tech giants are buying up millions of highly advanced semiconductor chips to process huge waves of complex data. Those chips need a permanent home, driving billions of dollars into the construction of specialized data centers to house endless rows of server racks. These massive server farms require staggering amounts of electricity, putting huge demands on regional energy grids and the utility companies that build them. Investors are viewing artificial intelligence as the primary physical infrastructure of the next decade, justifying the systemic influx of capital into these industrial-scale projects. This chart illustrates the sheer euphoria taking place in the stock market. You can see the S&P 500 climbing steeply, reaching an all-time high around 7,817 in August. But while the tech sector flies upward, broad economic indicators are quietly going flat or declining. At these sky-high valuations, a standard profit is no longer enough. These companies must now continually beat incredibly aggressive growth targets to maintain investor confidence. If that growth disappoints by even a fraction of a percent, the gap between Wall Street's optimism and the broader economy's heavy reality will quickly become a major problem for investors. To find the biggest immediate threat to this boom, we have to look away from stocks and check the bond market. Long-term U.S. Treasury yields have been climbing dangerously high. Recently, the 10-year yield hovered around 4.7%, while the 30-year yield crossed the 5% mark. Here is a diagram showing how those Treasury yields impact corporations. As these government yields climb, the cost of borrowing money across the entire financial system goes up right along with them. Because AI infrastructure is incredibly expensive to build, tech companies are forced to take on this financing, requiring significantly higher returns just to break even on those new data centers. The heavy burden of borrowing all that money could eventually weigh down the very stock valuations of the companies trying to build the future. And the entity controlling those crucial interest rates is the Federal Reserve. Recently, softer economic data brought the market's expectation for an immediate rate hike down to roughly 31%. But the central bank hasn't entirely defeated inflation yet. External pressures remain a stubborn threat. For instance, rising oil prices could easily introduce new inflationary pressure across the supply chain, forcing the Fed to rethink its strategy. This leaves policymakers trapped. Keeping interest rates aggressive chokes off corporate borrowing. The loosening monetary policy too quickly risks letting inflation run wild again. The artificial intelligence boom is currently betting that the Fed can execute a flawless balancing act. That level of uncertainty guarantees we will see volatility in the markets. There is also the final, traditional engine of the U.S. economy, the American consumer. This comparative bar chart puts two conflicting realities side by side. On the left, we see billions in corporate tech spending surging upward. But on the right, July retail sales data actively declined, exposing a real weakness in everyday household spending. While the tech sector appears resilient, everyday businesses like local retailers, restaurant chains, and travel companies are actively feeling the pinch from cautious shoppers. We are watching a bizarre paradox unfold. The economy is rapidly constructing futuristic trillion-dollar digital infrastructure at the exact same time that Main Street consumers are starting to run out of cash. So, does this intense divergence mean artificial intelligence is a massive financial bubble waiting to pop? Not necessarily. A high price alone doesn't equal a bubble. A bubble requires a complete disconnect from reality, and the productivity gains offered by AI are real, even if current expectations are highly stretched. But history gives us a clear lesson here. Revolutionary technology does not guarantee that every company building it will actually be a profitable investment at its current price. Moving forward, monitor two specific corporate metrics: AI company earnings to see if actual profits justify these valuations, and the trajectory of long-term Treasury yields. Next, track two broader macro signals: the resilience of consumer spending and every inflation report the Federal Reserve uses to make its policy decisions. Surviving a $5 trillion boom requires watching the entire macroeconomic board, not just staring at the most popular tech stocks. This is not financial advice. Always do your own research before investing.